Let me tell you a story about the fair value gap. Right now, it is easily one of the biggest trends sweeping through the trading space, and there is a very good reason for that. These gaps work remarkably well in the live market. But here is the catch: not all fair value gaps are created equal. Picture two different trading scenarios. In one, the setup completely fails, leaving traders trapped and taking a loss, while in the other, the trade plays out flawlessly. So, why did one succeed while the other fell apart? Well, I have a specific technique I use to instantly figure out when a fair value gap is actually valid and ready to trade. Once you add this method to your own trading arsenal, you will immediately see the accuracy of your trades improve. Before we dive into the secret, we need to completely understand what a fair value gap truly is. In the markets, we encounter both bullish fair value gaps and bearish fair value gaps. A gap simply happens when the price moves up or down by an insane, aggressive amount, leaving behind a massive candlestick on your screen. Picture a chart where the market has been quiet, and suddenly a massive, explosive green candlestick shoots upward. It moves so quickly that the sellers do not even get enough time to step in and counteract the movement. This creates a literal imbalance in the market. Naturally, the market seeks equilibrium, so sellers will eventually want to revisit and retest this empty zone. You can spot and mark a fair value gap quite easily without needing any complex indicators. Just imagine drawing a rectangular zone starting from the top wick of the candle right before the big explosive move, stretching down to the bottom wick of the candle right after the big move. That empty space trapped in the middle is your fair value gap. If you scan any asset, you will see these scattered everywhere. More often than not, the price will drift back down into this zone, fill up the imbalance, and then push back up to test the highs again. As traders, we can use this natural market rhythm to our advantage and profit from the move. However, if you have ever tried trading these gaps before, you have likely noticed they do not work all of the time. The reason is simple: you are probably trading an invalid gap. This brings us to the core of our story. What exactly makes a gap valid? There are exactly 6 key factors that must line up for a fair value gap to be worth risking your capital. The first rule is that the fair value gap must remain completely unmitigated. Because the entire purpose of this gap is a sudden price surge that leaves the other side behind, the zone must be fresh. It cannot have been tested yet. Imagine watching the price form that beautiful gap, but instead of continuing its rally, the very next candle immediately dips back down to touch the zone before rising again. If the price wanders down to that zone a second time later on, the setup is dead. We no longer consider it valid because it was already tested right after it formed. To keep its power, the gap must be completely untouched. If it has been mitigated, simply walk away. Moving on, the second factor requires us to watch closely how the candles react once they actually step inside the gap. We want the candlestick to either close perfectly inside the fair value gap or close in the direction of our trade. Visualize the price slowly descending into your marked rectangular zone. Instead of slowing down, imagine the candlestick plunging straight through the bottom line and closing firmly below it. If this happens, the setup is ruined. The gap becomes invalid. Instead, we want to see the price halt and close safely inside the zone. It is perfectly fine if a thin wick pierces through the bottom of the gap, as long as the thick, solid body of the candle ends up closing inside the gap or pushing back in the direction of the trend. If you see that, you are clear for a safe entry. The third piece of the puzzle involves stacking the odds in your favor by adding other confluences. A great way to do this is by identifying historical support and resistance levels. Think back to a previous price swing on your screen where the market bounced, leaving a clear support floor. Now imagine a fresh, untested bullish fair value gap forming directly on top of that exact same floor. You have just struck gold. This is an excellent confluence that heavily raises the chance of your trade working out. The exact same logic applies to bearish gaps. You want to hunt for a previous resistance level that lines up perfectly with your fair value gap to make it much stronger. As we continue, our fourth factor is all about location and priority. Some gaps are just naturally stronger than others, and a simple way to filter them is by checking where they sit relative to the entire price swing. Suppose you are looking at a strong upward trend that left behind a staircase of 3 distinct bullish gaps. The one sitting at the very bottom of that staircase will always be the strongest and hold the highest priority. Conversely, the highest gap near the peak is the weakest. In a perfect world, you should always aim to trade the lowest fair value gap possible. The rule flips for bearish setups. If you have a steep drop leaving several bearish gaps, the highest one claims the top priority. Factor number 5 works hand in hand with our previous rule to help you pinpoint that high priority gap visually. When you open your TradingView platform, go to your drawing panel and grab the GAN box tool. Go into the settings of the tool and make sure your price levels are set exactly to 0, 0.5, and 1. For long setups, draw this tool from the absolute bottom of the market move all the way to the top peak. You should never trade gaps hanging in the upper half of this box. You only want the ones resting in the lower, discounted portion. For short setups, draw the box from the high of the move down to the low, targeting only the fair value gaps sitting in the upper, premium portion. Following this simple visual trick ensures you only trade high priority zones. Before we reach the final factor, let us pause to understand the fuel behind these massive moves. A true fair value gap is rarely created out of nowhere. It usually happens right after the market sweeps liquidity. Imagine a pool of stop losses resting just below a recent low on your screen. Institutional algorithms often drive the price down just enough to trigger those stops, absorbing all that liquidity, and then aggressively reverse the market upward. That aggressive reversal is what leaves behind the massive imbalance we look for. Furthermore, while these setups appear on every time frame on TradingView, a gap found on a higher time frame, like a 4-hour or daily chart, carries significantly more weight than one found on a 1-minute chart. The higher the time frame, the more institutional money was required to create that imbalance, making it a far more reliable zone for your setup. Returning to our story, the sixth and final step happens before a fair value gap is even fully established. You must see a clear break of structure in the market. A break of structure simply means the price forcefully pushes past a previous prominent high or low. Imagine the price surges and forms a nice gap, but looking left, it fails to break the high it just made a few hours ago. That gap is completely invalid, and we do not trade it. What we really need to see for a bullish gap is the price confidently breaking past its previous structural high. As it forces its way through that ceiling, it will likely leave behind our fair value gap. Because it broke the structure, this gap is fully valid. The same goes for shorts. The price must shatter the previous structural low before creating the gap. If you weave all 6 of these threads together, you create the ultimate fair value gap setup, massively increasing the odds that the market will respect your zone. Let me paint a picture of how this looks in a live market environment. First, we watch the price make a distinct high on the screen, marking our potential line in the sand. We sit on our hands and wait patiently until a massive green candle forcefully breaks above this high. Next, we look at the aftermath of that break and spot a fresh, fair value gap left behind. We check our first rule. The gap is unmitigated, meaning no subsequent candles have dipped into it yet. We then pull out the GAN box tool on TradingView, dragging it from the start of the swing low up to the new swing high. We notice there are actually 2 gaps, but one is sitting up in the upper expensive section. We mentally remove it from our plan entirely, leaving us with a prime gap down low in the discounted area. Looking closer at this remaining lower gap, we spot a prior structural support level sitting right inside it. It is a beautiful setup, checking all the criteria of a valid zone. We simply let the price naturally drift back down into our highlighted area. Once it hits, we do not panic. We watch the candlestick closely. In this scenario, the candle dips its wick in, but closes right inside the zone, proving the market is respecting this specific area. All 6 criteria are perfectly met. We set our take profit target at the peak of the original move and tuck our stop loss safely below the low of the candle that birthed the gap. Just as we expected, the price finds its footing and booms right after touching our validated fair value gap, delivering a beautiful, calculated trade. Combine all 6 of these steps into your daily routine, and you will instantly watch your market reads become much sharper. Trading is not about catching every single move. It is about waiting patiently for the one setup that aligns perfectly with your rules.